We're well below the top, which was like $123 on silver. What's going to happen is that silver will trade in that inside that band of the top and bottom for a while, and then at some point it will break out. If it breaks out to the downside, I think we probably go as low as 50 probably. And if we break out to the upside, I would say 150, maybe even $200. It's going to struggle. Every time it goes up a bit, there will be people who jump on board saying, oh, it's on its way up. But equally, there'll be people who say, I should have sold at 120. Okay, I'm happy to accept 110. And the reason the CFD companies or betting companies do this is to make sure they never get into a situation of a loss. So as the price starts to decline a little bit towards the level where the CFD company could lose money, or on COMEX where the broker could lose money, so it touches that, but you can come in second, third, fourth. But in a fast-moving market, there won't be so many buyers sitting there to absorb your orders. The way to trade precious metals is to buy physical gold or silver, and then when the price has gone up, to sell it. That's not what people should be doing. They should be buying.
So if we go back to gold and silver, do you see what we saw as sort of the major top, and now we're getting a reversal, or how are you currently looking at the recent bull run we've seen?
Well, I think we're trading. We've had this what turned out to be a speculative blow-off. I mean, it's not necessarily a top, but it looked like a top because when we had the announcement of Kevin Warsh being appointed as the new chairman of the Federal Reserve to replace Jerome Powell when he retires in May, Kevin Warsh was seen as a surprise in terms of what people knew about him, because when people looked him up, they found that he was a person who could be a staunch defender of the Federal Reserve's independence, and the kind of person who probably wouldn't agree with quantitative easing. And that was based on his tenure as a board member on the Fed back in 2011. And we'll find out if that's really the case. But I think that was the spark which lit the fire. So if you think about a forest that's full of very, very dry wood, you never know when it's going to burn, but it's been there for a long time. The wood's dry, getting drier and drier, and then suddenly there's a spark and the flames spread. So that was the spark.
Policy transitions often move markets more than interest rate decisions themselves. As Clive Thompson notes here, leadership expectations at the Federal Reserve can shift liquidity forecasts overnight, especially when quantitative easing assumptions change. Historically, gold rallies often stall when markets anticipate tighter monetary discipline, similar to reactions seen during the 2013 taper tantrum period. Investors should remember that metals respond less to personalities and more to real yields, which remain historically elevated near multi-year highs. The narrative sounds dramatic, but policy credibility cycles matter more than speculation spikes. And Clive Thompson suggests the next phase depends on whether policy expectations actually match reality.
But what caused the flames to spread? What caused this cascade of selling? Well, as the price of silver, especially, rose rapidly, a lot of people entered the market using CFDs, that's contracts for difference, which obviously lay off their risk in COMEX and other places like that. But when you use CFDs, you typically have a 10-to-1 leverage ratio. You can use more or less, depending on where you do the business, which means that the CFD provider, this would apply also to people trading futures, but in a slightly different way. The CFD provider is going to put in place an automatic stop loss, whether you like it or not. That stop loss might be adjusted according to how leveraged you are, how much money you've got in the account, and other factors. But in general, when people are trading CFDs, they're trading on a leverage basis. And we had people all around the world doing that. And ultimately, those risks are laid off via COMEX and other places with what's called stop losses. Stop losses are trigger points, price levels, at which a position will be automatically closed. And if we're talking about someone who's long, closed means they sell their position if the price goes below a certain level.
Leverage quietly turns small corrections into market-wide liquidation events. As Clive Thompson explains, 10-to-1 leverage means a 10% move can erase nearly all trader capital, forcing automated selling regardless of fundamentals. We've seen this pattern repeatedly, from the March 2020 commodity crash to crypto liquidations in 2022, where billions were wiped out in hours. Retail leverage often expands near tops because rising prices create false confidence and easy margin availability. What looks like panic selling is often just math playing out through risk management systems. Clive Thompson warns the next move depends on how much leverage still remains hidden in the system.
And the reason the CFD companies or betting companies do this is to make sure they never get into a situation of a loss. So as the price starts to decline a little bit towards the level where the CFD company could lose money, or on COMEX where the broker could lose money because his client has got a position, they will say either to the client, stump up more money, and that's and typically you have to stump it up immediately to make sure you're covered for after the price decline, or more likely, especially in the case of the contract for different sites, it's a stop loss, which is a hard one, which will be automatically triggered at, let's say, 5 or 7% away from the. Let's say you've got 7% running, and the price has gone down by a couple of percent. You're immediately getting too close to the point where you're losing money, and it'll automatically trigger the stop loss. So each stop loss, as it's triggered, causes an instant sale. Now, that sale doesn't automatically happen at the stop loss price. It happens at the next price traded after the stop loss has been touched by somebody else. Now, in a normal market, that often means you get the stop loss price because there's an army of people willing to sell at a certain price. So the first one sells at the stop loss price, but there's an army of people willing to buy at the stop loss.
Margin systems are designed to protect brokers, not investors. As Clive Thompson points out, forced liquidation thresholds around 5 to 7% price movement can create selling pressure far beyond what fundamentals justify. During volatile commodity sessions, liquidity gaps often widen spreads by multiples, meaning stop-loss execution rarely matches expectations. This is why flash crashes in metals and equities tend to overshoot before stabilizing. Structural selling overwhelms natural buyers. Investors holding leverage positions rarely control their exit once volatility accelerates. Clive Thompson argues the real risk isn't price direction, but the speed at which liquidity disappears.
So it touches that, but you can come in second, third, fourth and get the stop loss price too. But in a fast moving market, especially the one we've seen, there won't be so many buyers sitting there to absorb your order. So when your order goes through, someone touches, let's say, $110, which was your stop loss, your next trade, you'll get the next trade, which might not be at $110. It might be $109.95. But of course, there's going to be another person with a stop loss at $109.95. So his stop loss gets triggered and he gets traded at, let's say, $109.85. And guess what? There's another person behind that with a stop loss of $109.85. And so it goes off. So we then have this cascading series of stop losses, each one creating a sale, driving the price a little bit lower, which then triggers the next one below, and so on. And of course, there would have been millions of these stop losses sitting around in different places all around the world. And obviously, a lot of people got the money they had in their CFD accounts effectively mostly wiped out by that fall. And of course, they're all sitting there burned.
Liquidity vanishes precisely when investors need it most. As Clive Thompson describes, cascading stop-loss chains create what traders call air pockets, where prices fall faster than buyers can react. Similar mechanics drove the 2010 flash crash and the 2022 nickel market spike on the London Metal Exchange. When millions of automated orders trigger simultaneously, price discovery temporarily breaks down. This isn't market manipulation, it's structural fragility built into electronic trading systems and leveraged positioning. Long-term investors often mistake these events for fundamental collapses. Clive Thompson says understanding liquidity risk may matter more than predicting price direction.
So what we're doing now, we're sort of, I think the price went down to, I can't remember how low it got now. Was it 60 or something at one point, 70? I don't know where it was, because it was such a fast-moving market, nobody really watched it. And we're sitting in the mid-80s now. So we're well below the top, which was like $123 on silver, and we're somewhat above the bottom of the range, although I would say we're closer to the bottom of the range than the top of the range at the moment. So what's going to happen is that silver will trade in that inside that band of the top and bottom for a while, and then at some point it will break out to one side or the other. And if it breaks out to the downside, I think we probably go as low as 50 probably. That's just a guess, I don't know that. And if we break out to the upside, I think it's on the way to, well, much higher levels. I would say 150, maybe even $200.
Yeah, okay, really interesting. So you don't have one or the other perspective, you just think it's very much depends on the range.
Markets often spend more time moving sideways than trending, and that's where patience gets tested. As Clive Thompson notes, range-bound commodities historically trap momentum traders, while long-term capital quietly accumulates positions. Silver, falling from roughly $123 to the mid-80s, represents a drawdown near 30%, which is large but not unusual for volatile commodity cycles. The real question investors should ask is whether industrial demand and ETF inflows confirm accumulation during this consolidation phase. Breakouts rarely happen when everyone expects them. Clive Thompson suggests consolidation periods often determine the strength of the next multi-year move.
Well, I prefer to go with the longer term view, which is the supply-demand imbalance and the geopolitical situation and the uncertainty around the world, which means that, in my opinion, the demand for silver is going to continue, not only from industrial users, but it's also going to continue from investors who will say, I'm going to go down and buy myself a few silver coins just because I want to get started. So I think that's going to continue. So I'd rather go for the upside, but of course this is not supposed to be investment advice. It's just a personal opinion of what I think is more likely, but it's not going to, it's not going to be a straight line. We've got a long period now of sitting in this range. It's going to struggle. Every time it goes up a bit, there will be people who jump on board saying, oh, it's on its way up, but equally there'll be people who say I should have sold at 120. Okay, I'm happy to accept 110, and they'll sell out. So we've got this pressure. As we go higher price, the pressure, a number of people are willing to sell at those higher prices increases. But as we go lower, a lot of people have missed the boat who will say, I wish I could have bought at the bottom.
Long-term supply stories often sound convincing, but timing is where portfolios succeed or fail. As Clive Thompson highlights, industrial silver demand tied to solar panels and electronics has grown steadily since 2020, yet prices still move primarily with liquidity cycles and real interest rates. Investor psychology creates resistance zones because previous buyers look to exit near old highs, creating natural selling pressure. This is why commodity rallies often stall below prior peaks before fundamentals catch up. Strategic investors watch positioning data, not headlines. Clive Thompson believes sentiment shifts usually happen before supply shortages appear in pricing.
So we kind of probably stay in this range, between the top and bottom of the recent swing. But once we break out, that kind of tells you the direction, and then you have to listen to what the market's saying about itself and take action, i.e. sell it. If it's selling, sell into it. And if it's buying, jump on board quickly.
Yeah, interesting. And I think one interesting phenomenon we saw with physical, I guess, gold and silver is that actually, if you're trying to sell it close to the tops, it was sort of quite a large discount. I think, sometimes 30% discount from trying to sell physical versus the actual price. So is that just, as you said, opportunistic people trying to sell, or does that maybe put into question whether you should actually own sort of physical precious metals?
Yeah, well, a lot of people have made the mistake of thinking that the way to trade precious metals is to buy physical gold or silver, and then when the price has gone up, to sell it. That's not what people should be doing. They should be buying the physical metal because they want to have something they can keep forever, a parachute, an emergency fund, and something which will hold its value over the very long term, and hold its value in a way where you do not need permission from anybody else to touch it or take it or use it.
The biggest misunderstanding in precious metals is confusing liquidity with ownership. As Clive Thompson explains, physical metals often trade at steep discounts during peaks because dealer inventories, spreads, and local demand distort pricing. In March 2020, for example, physical gold premiums surged while buyback prices lagged spot markets significantly. Physical metals function more like insurance than trading instruments, which changes how investors should evaluate them in a portfolio. Liquidity risk matters more than price volatility when markets become stressed. Clive Thompson says the next insight reveals why premiums behave differently in crises.
That's physical for you. And given the way the world is going with all kinds of geopolitics and bank seizures and sanctions and all kinds of things, I can see that the number of people who'd like to have something outside of the financial system is not going to go down. So that's the positive side. But you shouldn't be doing that thinking, gosh, I'm going to, if it goes up, I'll sell it. I'll buy some insurance today, but if that forest fire gets closer, I'll sell it and make a profit. It's like being on the Titanic, right? You're on the Titanic, and there's only a certain number of life jackets, and you happen to earn a life jacket, and the price, and then it hits the iceberg, and the price of life jackets goes up because there aren't enough for everybody. So you say, great, I'll sell my life jacket at the higher price, but then the water starts coming in the ship, and you want to buy your life jacket back. What do? Well, you might get to the point where nobody's going to sell it to you. So it's like that with gold and silver. You don't know. You shouldn't be trading it.
Insurance only works if you still own it when the crisis arrives. As Clive Thompson notes, geopolitical uncertainty since 2022 has increased central bank gold purchases to record levels above 1,000 tons annually. That behavior signals institutions view precious metals as systemic protection rather than speculative assets. Investors often underestimate how quickly liquidity disappears during financial stress events like capital controls or banking freezes. The Titanic analogy sounds dramatic, but liquidity shortages during crises are historically real. Portfolio resilience depends on preparation, not timing. Clive Thompson argues the next discussion shifts from protection assets to portfolio allocation realities.
You shouldn't be buying and selling based on the price, because if at the end of the day you're keeping it for the disaster, and maybe to pass down the generations, you shouldn't be keeping the physical to trade. If you want to trade physical, if you want to trade to make a profit, the way to trade to make a profit is to trade the futures or trade the ETFs. Of course, you're trading paper, and I'm not saying to people you should own paper, because that's not what I'm talking about. I'm saying if you plan to buy today hoping to sell tomorrow, paper's the way to go, because there's almost no difference between the buy and ask spread price if you're buying an ETF, and almost no commission if you're buying enough size. So you can buy today and sell tomorrow and make a profit, provided the price went in the right direction. You certainly can't do that if you own physical coins or bars, because when you buy physical coins or bars, you've got a dealer markup, which covers the cost of making the coin, it covers the rent, it covers the distribution costs, and it covers the dealer's time and everything which goes with it.
The real divide here isn't gold versus paper. It's insurance versus liquidity. As Clive Thompson makes clear, physical metals are structurally inefficient for short-term trading because dealer spreads can run 3 to 8% on silver coins, instantly putting traders in a hole. ETFs, by contrast, often trade with penny-wide spreads and expense ratios under 0.5%, making tactical positioning viable. But that efficiency comes with counterparty exposure and market hour dependency. Investors need to decide whether they are hedging systemic risk or speculating on price momentum. Clive Thompson's distinction forces a portfolio discipline most retail investors never apply. Next, the premium trap becomes even more uncomfortable when markets get stressed.
So you're paying well over the odds for the silver or gold content. And in times of stress, that premium will increase. But you go and try and sell it back to the dealer, he's not going to pay you more than usually, not much more than the gold price, if at all, or much more than the silver price. Of course, you could sell it privately if you wanted to, and probably capture roughly the same sort of premium. But the trouble with that is you've got to find a buyer somewhere. And that's not so evident, and it's got all the risks which go with it, unless you're dealing with a trusted counterparty. So, obviously, if you go back to the dealer, there is the convenience that you just go to one place and he's going to take it off you. He's going to give you a price, but you might not like the price, but at least he's always there for you. But as I say, the price at which he'll sell to you will always be somewhat higher than the price at which he'll buy back on the same day. So that's, I don't ever say people should buy physical to trade, but of course some people have held the physical for 5 or 10 years, and they've got these monster boxes of 500 coins, and they're saying, "Wow, it's 3 times what I paid. I will take the money off the table." And the fact that when they bought it, they paid 5% or 10% too much doesn't matter when it's gone up 300% or 200%. They say, so what if I paid 10% too much? It doesn't matter. I'm out of here. I'm going to take the money and tell everybody how clever I am to have bought it.
Premiums expand in panic, but they don't protect you on the way out. Clive Thompson is highlighting a structural asymmetry. Dealers widen spreads during stress, yet buybacks rarely reflect the same emotional premium buyers once paid. In March 2020, retail silver premiums surged over 20%, but resale prices lagged spot dramatically. That's not manipulation, it's inventory risk management. Long-term holders who captured 200 to 300% gains can absorb that friction, but short-term traders cannot. Clive Thompson's warning exposes a liquidity illusion many investors only discover when they try to exit. And what comes next shifts from retail behavior to institutional positioning.
Now, banks and financial institutions are starting to add gold as an asset allocation, and we're seeing it coming back a bit. But it doesn't mean to say that most portfolios have gold in them. I don't know what percentage of global portfolios have gold in them, but perhaps the ones which are allowed to have gold, because don't forget, many portfolios couldn't. Perhaps the ones which are permitted to have gold have an average of maybe 1%. That's just a guess. I don't have a hard statistic on that. But many portfolios can't own gold. For example, if you have an ETF tracking a particular equity index, it can't own gold. If you have a trust or a foundation which has got some bylaws which specify how the money is going to be invested, it can't have gold. So there's many types of if you have a Luxembourg insurance policy, for example, it's not allowed to have gold by law. So there's many types of portfolios which can't have gold, but those which could have gold, I still think the figure is pretty low, with exceptions where some will be at 5 or 10%. But one of the things which has been driving the gold price, apart from the ongoing central bank buying, I think has been the change of attitude amongst the man in the street, Joe Public.
Gold feels mainstream, but structurally it's still marginal inside institutional portfolios. As Clive Thompson suggests, allocations among eligible funds may average near 1%, while central banks have been buying over 1,000 tons annually since 2022. A stark contrast between public and sovereign positioning. Many passive vehicles legally can't hold gold, which artificially suppresses exposure across trillions in indexed assets. That means even a shift from 1% to 3% would represent massive incremental demand. Clive Thompson is pointing to a quiet allocation gap that markets rarely price in early. Next, the conversation turns from allocation math to debt dynamics that could force that shift.
People have started to realize that the days of low inflation fiat currencies, and I come back to my definition of inflation before, not the CPI, those days of low inflation are numbered, and we might be going into a very high inflation environment because of the levels of government debt. The problem with government debt being that it is expanding and continues to expand much faster than the economy is expanding. So it's expanding faster than GDP in absolute amount. And the interest burden on that debt is expanding considerably faster than the debt is expanding, because not only are they piling interest upon interest in terms of what they have to borrow, but the interest rates they're having to pay are generally much higher than the interest rates that they were paying over the last 10 or 15 years since the global financial crisis. Don't forget, after the global financial crisis, interest rates around the world effectively went to zero or pretty close to zero, which meant that governments were borrowing at very low interest rates. But as that debt matures, that low interest rate debt still has to be refreshed, but it can't be refreshed at that same interest rate. They have to borrow the new money at a much higher rate. So we've got the interest burden rising rapidly.
This isn't about CPI, it's about compounding interest. Clive Thompson is highlighting that government debt in major economies has been growing faster than GDP, while refinancing costs have surged since rates lifted in 2022. In the US, net interest outlays recently crossed $1 trillion annually, more than defense spending. When zero-rate debt issued after 2008 rolls into 4 to 5% yields, fiscal pressure accelerates mechanically. That math doesn't require hyperinflation to become destabilizing. Clive Thompson is pointing to a structural squeeze policymakers rarely acknowledge publicly. And the final part asks what happens if that squeeze spirals beyond control.
We've got the debt rising faster than GDP, so we are heading towards a situation where there is a risk, not a certainty, but there's a risk that it spirals out of control. And people are starting to see that. So what they're doing is, rather than say I'm buying gold for the keep pace with inflation, a rather dull, boring asset, Warren Buffett has said it's a pet rock which just sits there and looks at you. They're now starting to say, what if? What if this does go horribly wrong? What if the government doesn't cut spending? What if the government doesn't raise taxes? What if the situation just gets worse and worse, as seems to be happening? Well, we're at 5 minutes. It looks like we're at 5 minutes to midnight. What's my plan B? Well, I'll get some gold, because I know the gold will be there when we get to the other side of whatever's coming. Don't know what's coming. It could be, could be a bail-in. It could be a hyperinflation. It could be just high inflation. It could be, it's unlikely to be a default. It could be some capital controls. It could be an alternative currency being issued. It could be ration coupons. There's many potential scenarios where some rather drastic action might be taken to rein in the let's say, a financial crisis for the government.
The shift isn't about returns, it's about contingency planning. Clive Thompson frames gold not as an inflation hedge, but as a response to tail risk, bail-ins, capital controls, or currency restructuring. Historically, extreme fiscal stress has produced policy shocks, from Cyprus bail-ins in 2013 to capital controls in Greece in 2015. Investors aren't predicting apocalypse. They're pricing non-zero probabilities. Even Warren Buffett's pet rock critique ignores that insurance assets are meant to underperform, until they don't. Clive Thompson is tapping into a psychological pivot now visible in household asset flows.